SPY versus SPYM, Comprehensive ETF Comparison. 1. Core Portfolio Composition. Both SPY and SPYM track the S&P 500 index and aim to replicate its performance by holding essentially all 500 of its constituents. Each uses full replication, meaning they hold every stock in the index, no sampling, which keeps tracking error very low. InvestLane.com. Index tracked, S&P 500, large cap US equities, for both funds. Number of holdings, SPY holds 503 stocks, per its December 2025 data, while SPYM holds 504 stocks. This minor difference can fluctuate with index changes or fund accounting, but both include essentially all S&P 500 companies. In practice, the portfolios are nearly identical in composition. SSGA.com, SSGA.com, SSGA.com. Replication method. Both funds follow full index replication, holding each S&P 500 component at approximately its index weight. Neither fund uses significant sampling or substitutes, ensuring very close tracking of the index's sector and stock exposure. InvestLane.com. Operational structure. One notable difference is structure. SPY is a unit investment trust, UIT, an older ETF structure, whereas SPYM is a standard open-end ETF. The UIT structure of SPY prohibits reinvesting dividends or lending out securities before distribution dates. In contrast, SPYM's open-end structure allows it to automatically reinvest dividends internally and potentially engage in securities lending. This structural nuance means SPY tends to hold a bit more cash between quarterly dividend payouts, while SPYM keeps virtually all assets invested. Over time, this gives SPYM a tiny performance edge due to full dividend reinvestment and flexibility, an effect on the order of only a few basis points, but present over long periods. ETFsavant.com. 2. Top 10 Holdings Comparison. Both ETFs are market cap weighted and thus heavily concentrated in the same megacap technology and internet companies. The top 10 holdings in each fund are nearly the same and mirror the S&P 500's top names. The table below shows a side-by-side comparison of the top 10 holdings, with their index weights, for SPY and SPYM. Rank. Holding. SPY weight. SPYM weight. 1. NVIDIA, NVDA. 7.75%, SSGA.com. 7.74%, SSGA.com. 2. Apple AAPL. 6.87%, SSGA.com. 6.86%, SSGA.com. 3. Microsoft MSFT. 6.15%, SSGA.com. 6.14%, SSGA.com. 4. Amazon.com, AMZN. 3.84%, SSGA.com. 3.84%, SSGA.com. 5. Alphabet Inc. A, GOOGL. 3.12%, SSGA.com. 3.11%, SSGA.com. 6. Broadcom, AVGO. 2.8%, SSGA.com. 2.79%, SSGA.com. 7. Alphabet Inc. C, GOG. 2.5%, SSGA.com. 2.49%, SSGA.com. 8. Meta Platforms, Meta. 2.46%, SSGA.com. 2.46%, SSGA.com. 9. Tesla, TSLA. 2.16%, SSGA.com. 2.16%, SSGA.com. 10. Berkshire Hathaway B, BRK.B. 1.58%, SSGA.com. 1.58%, SSGA.com. Top 10 Holdings Insight. The lists are identical, the same 10 companies, and weights only differ by a few hundredths of a percent. For example, Apple is 6.9% in both, and Microsoft 6.1%, with only trivial rounding differences. This reflects that both funds hold virtually the same stocks in the same proportions as the S&P 500. SSGA.com, SSGA.com. Any slight weight variance, often less than 0.1% difference, can arise from day-to-day fund flows or rounding. Notably, SPY and SPYM each hold both Alphabet share classes, Google, and both are in the top 10. Nvidia, Apple, Microsoft, Amazon, and Alphabet together dominate both portfolios, consistent with the S&P 500's market cap concentration in tech/growth giants. 3. Top 10 holdings concentration. Because the top holdings match, both ETFs have a very similar concentration in their top 10 stocks. As of early 2026, roughly 37% to 38% of total assets are in the top 10 names for each fund. StockAnalysis.com, StockAnalysis.com. SPY, approximately 37.3% of the fund is invested in its top 10 holdings. StockAnalysis.com. SPYM, approximately 37.3%, about the same, is in the top 10 holdings. Some sources rounded this to 37.8% for SPYM, but the difference is negligible and due to timing. Essentially, both funds have an equal top 10 concentration. StockAnalysis.com. This means both SPY and SPYM are similarly diversified, or concentrated, at the top. Their risk and performance are heavily driven by the same leading companies. There's no meaningful difference in diversification. Outside the top 10, each fund still holds 490 other stocks that make up 62-63% of assets, covering the full spectrum of the S&P 500 across all sectors. 4. Cost structure, expense ratios and fees. This is where the biggest difference lies. SPYM is an ultra-low-cost ETF, while SPY has a higher fee typical of the first-generation ETF it is. SPY expense ratio, 0.0945% annually, about 9.45 basis points. In practical terms, an investor pays about 95 cents per $1,000 invested per year. This fee has come down slightly over the years but remains higher than many S&P 500 ETF peers. SSGA.com. SPYM expense ratio, 0.02% annually, 2 basis points, one of the lowest fees in the industry. That's just 20 cents per $1,000 per year, making SPYM nearly 5 times cheaper than SPY on an annual fee basis. SSGA.com, Investlane.com. Neither fund charges front-end loads or redemption fees, the expense ratio is the main cost. Both have tight tracking, so the expense ratio directly drags on returns relative to the index. Over time, SPY's higher 0.09% fee will shave returns slightly more than SPYM's 0.02% fee. For long-term investors, this difference compounds. For example, over decades, the fee gap could mean thousands of dollars saved with SPYM. Investlane estimates $16K saved on a 30-year, regular investment scenario. Investlane.com. Other structural cost factors. Because SPY is a UIT, it cannot engage in securities lending, which many ETFs do to earn extra income to offset expenses, and it must hold dividends in cash until quarterly distribution. SPYM, as a conventional ETF, can use such strategies. State Street's funds often lend out portfolio securities and reinvest cash internally. These differences, while not explicit fees, make SPY slightly less efficient. Indeed, SPYM has a small performance edge over SPY purely due to these structural factors and lower fees. Historically, SPYM has outperformed SPY by a few basis points per year, 15.23% versus 15.15% annualized in one analysis, despite tracking the same index. ETFsavant.com. Bottom line on costs, SPYM clearly wins on cost. Its 0.02% fee is almost negligible, ideal for cost-conscious long-term holders. SPY's fee, while low in absolute terms, is relatively high for an S&P 500 ETF today. Active traders might tolerate SPY's higher expense for other benefits, but purely from a fee standpoint, SPYM is superior. Investlane.com. 5. Fund size and liquidity. Assets under management, AUM. SPY is one of the largest ETFs in the world. SPY AUM, roughly $700 billion in assets, as of end of 2025, and recently around $6.694,702b. It has an immense capital base. Investor.v, Vanguard.com, StockAnalysis.com. SPYM AUM, approximately $95 to $105 billion. This is large by most standards, making SPYM a top 20 ETF by size, but SPY is 7 times bigger. StockAnalysis.com, Investor.v, and Guard.com. Trading volume, SPY's trading liquidity is unmatched. SPY trades about $50 to $55 billion worth of shares per day on average. In share count, that's around 74 million shares traded daily, 3-month average. SPY is the most heavily traded ETF globally, often used by institutions for hedging and cash equitization. ETFsavant.com, Investlane.com. SPYM trades around 9 to 10 million shares per day, 3-month average, which equates to roughly $0.8 to $0.9 billion in daily turnover at its $80 share price. This is healthy liquidity, but an order of magnitude lower than SPY's. On high volatility days, SPY can trade over 100 million shares, whereas SPYM's volume, while also high, remains much lower. Investlane.com. Bid-ask spreads. Both funds benefit from their large size and arbitrage with S&P 500 futures, keeping spreads tight. SPY typically has a 1-cent bid-ask spread, which on a $6.80 share is effectively 0.0015%, essentially 0% rounding to 0%. Even in volatile periods, SPY's spreads remain a few cents at most due to massive market maker participation. Investlane.com. SPYM also often trades at a 1-cent spread, but since its price is $80, that's about 0.012%. Its 30-day median spread is around 0.01%. In practice, a 1-cent spread on SPYM is very tight in absolute terms, though slightly wider in percentage than SPY. During calm markets, SPYM's spread can be just a penny. In volatility, it might widen a bit more than SPY's but generally remains very tight given the fund size. Investlane.com. Liquidity bottom line, SPY offers institutional-grade liquidity. One can trade millions of dollars of SPY with virtually no price impact, ideal for active traders or very large orders. SPYM's liquidity, while lower, is still excellent for almost all retail and many institutional purposes. Tens of millions of dollars can trade daily without issue. However, for extremely large or rapid trades, SPY has the edge. Its higher share price and volume make transaction costs minuscule, often just that 1-cent spread. ETFsavant.com. SPYM's liquidity is strong but not as deep as SPY's. This is reflected in SPY's popularity with short-term traders and arbitrageurs, whereas SPYM, formerly SPLG, has been used more by buy-and-hold investors. In summary, SPY is significantly larger and more liquid, but SPYM is no slouch and is plenty liquid for most needs. It only really matters at truly huge trade sizes or for hyperactive trading. 6. Tracking and holdings details. Index tracking. Both funds track the S&P 500 extremely closely. Since they own virtually all the index constituents, tracking error is minimal. Any difference in performance between the two comes down to expense ratio and structural factors, not portfolio content. Over the long run, SPYM's returns have been slightly higher than SPY's by the difference in fees and reinvestment. As noted, a recent 10-year look showed SPYM ahead by 0.08% annually, attributable to its 0.0745% lower fee and ability to keep cash invested. This confirms both are tracking the index well, with SPYM's efficiency shining through. Both funds fully replicate the index weightings, so sector allocations are virtually identical, information technology 35%, financials 13%, etc., matching the S&P 500 proportions. For example, at November 2025, SPY and SPYM each had 35.3% in tech, 13.1% in financials, 10.5% consumer discretionary, etc., with differences on the order of 0.01%. Investlane.com, Investlane.com, Investlane.com. Number of holdings. As mentioned, SPY held 503 stocks versus SPYM's 504 at last count. This slight discrepancy can occur if, for instance, one fund includes a small recent addition or has split a share class differently. In some data sources, SPYM is noted with up to 507 holdings, likely because SPYM's portfolio might temporarily hold a few ancillary items, like a cash placeholder, or both share classes of dual-class companies counted separately, or minor index transition securities. SPY as a UIT might occasionally exclude tiny securities, e.g., SPY doesn't immediately reinvest cash into new securities. However, in practical terms both are fully invested in the index. stockanalysis.com. Replication accuracy, both achieve very high replication accuracy. Neither fund uses optimization or sampling, they hold essentially 100% of the index names by weight. SPY's structure precludes holding derivatives, so it doesn't use futures or swaps for tracking, nor does SPYM for this index. As a result, tracking error, the volatility of the performance difference versus the index, is extremely low for both, on the order of a few basis points. Day to day, their NAVs move virtually in lockstep with the S&P. Over a year, SPY will lag the index by roughly its 0.0945% fee, and a tad more if cash drag has any effect, while SPYM will lag by about 0.02%. In 2025, for example, SPY's NAV return was 17.69% versus 17.88% for the index, while SPYM's was 17.81% versus 17.88% index, very close in both cases, with SPYM slightly nearer the index thanks to lower costs. Investlane.com, SSGA.com. In essence, both funds deliver the same S&P 500 exposure. There are no meaningful differences in portfolio composition or strategy, only structural elements, fee, UIT versus ETF, cause tiny performance divergences. Investors can expect nearly identical holdings, sector weights, dividends, and index tracking from SPY and SPYM. 7. Portfolio turnover and cash reserves. Both SPY and SPYM are designed to be low turnover, passive index funds. Portfolio turnover. Each fund's turnover is extremely low, reflecting the S&P 500's low turnover. SPYM reported an annual turnover of 3% for fiscal year ending June 30, 2025. SPY similarly has about 3% turnover, FY 2025. This means in a given year, only 3% of the portfolio's value is traded on average, mainly due to index changes or corporate actions. Such low turnover minimizes transaction costs and taxable distributions. Neither fund does active trading beyond what index maintenance requires. Essentially, both buy and hold the index components unless the index itself changes. Investor.v, Engard.com, Investor.v, Engard.com. Cash reserves. Both funds aim to be fully invested. However, SPY tends to hold a slightly higher cash reserve than SPYM at any given time. As of end 2025, SPY had about 0.3% in short-term reserves, cash, whereas SPYM held only about 0.1% in cash. This difference is again due to structure. SPY's UIT structure accumulates cash from dividends and cannot reinvest it until distributing to shareholders quarterly. SPYM, being a traditional ETF, can use incoming dividends to buy more stocks or can invest a tiny bit in futures to equitize cash, keeping cash drag minimal. In practice, both keep cash levels very low, 99% plus invested at all times, but SPY's cash might tick up just before a payout. Investor.v, Engard.com, Investor.v, Engard.com. What these figures mean: neither fund holds significant cash aside from pending dividends or minor liquidity needs. SPYM's 0.1% is basically a rounding error. Both are essentially fully invested in the equity market almost all the time, ensuring investors get the market's returns. The slightly higher turnover of 3% simply reflects that the S&P 500 index has a few additions/deletions each year, companies entering or leaving the index, which the funds must trade. There's no active management-driven turnover. 8. Financial metrics and portfolio characteristics. Since SPY and SPYM hold the same stocks, their portfolio characteristics metrics are virtually identical. Key fundamental metrics as of end of 2025 were as follows: Investor.v, Engard.com, Investor.v, Engard.com. Median market cap, $460.5 billion for both funds. These are large cap focused. The median market cap of S&P 500 companies is very high. Both portfolios tilt toward megacaps due to the weighting scheme. Investor.v, Engard.com, Investor.v, Engard.com. Price/earnings ratio, PE 27.6 times, forward FI1 earnings. This indicates a growth-tilted, large-cap blend profile. Both funds share the same index valuation metrics at any given time. Investor.v, Engard.com, Investor.v, Engard.com. Price/book ratio, PB 5.1 times. Investor.v, Vanguard.com, Investor.v, Vanguard.com. Return on equity, ROE 35% aggregate ROE for the portfolio. This high number reflects the profitability of the large companies in the index, and it's identical for SPY and SPYM. Investor.v, Vanguard.com, Investor.v, Vanguard.com. Earnings growth rate, estimated 3 to 5 year EPS growth around 13 to 15%. SPYM fact sheet showed 13.03% for 3 to 5 years EPS growth. Both funds have the same growth outlook since they hold the same companies. SSGA.com. Dividend yield, both yield roughly 1.1%, SISI 30-day yield, SPY 1.03%, SPYM 1.11% at December 2025. The small difference is likely due to timing of dividend collection. Effectively their yield is the S&P 500's yield, 1.1%. SSGA.com. Foreign holdings, 0.5%. A tiny portion of the index, and thus each fund, is in companies domiciled outside the US, for example, companies like Accenture or Alibaba if they appear in the index. Both funds have the same small foreign exposure by design of the index. Investor.v, Vanguard.com, Investor.v, Vanguard.com. Sector allocation, identical across both. For example, IT 34-35%, financials 13%, healthcare 9-10%, consumer discretionary 10-11%, communication services 10-11%, industrials 8%, etc., matching the S&P 500's breakdown. The sector weights are the same to 2 decimal places in many cases. See InvestLane's table showing sectors line up exactly. Investlane.com, Investlane.com, Investlane.com. In summary, all fundamental and portfolio metrics line up 1 for 1 between SPY and SPYM. There is no difference in style, both are large cap blend, in market cap exposure, valuation, or growth rates. Any reported differences are due to rounding or slightly different reporting dates. For an investor analyzing things like PE or sector exposure, SPY and SPYM are interchangeable. 9. Options trading considerations and strategies. One of the biggest practical differences for traders is the options market for each ETF. SPY is renowned for its expansive and liquid options market, whereas SPYM's options are newer and less utilized. Here's a breakdown. Availability of options. SPY has one of the most active options markets in the world. Options on SPY are listed with multiple expirations per week. In fact, SPY offers Monday, Wednesday, and Friday weekly options, in addition to standard monthly expirations and longer-dated expiries. This gives traders incredible flexibility to target specific short-term time frames. Additionally, SPY options come in monthly cycles, quarter-end expiries, and LEAPs, long-term equity anticipation securities, going out years. Essentially, at any given time, SPY might have dozens of expiration dates available. OptionCharts.io. SPYM's options chain is much more limited. As of early 2026, SPYM options exist. The fund's size and popularity post-2025 have led to options listings, but they typically have only the standard monthly expirations, third Friday of each month, and a few longer-dated expiries, quarterly or yearly. For example, one could trade SPYM options for February 2026, March 2026, June 2026, etc., but SPYM does not have the Monday/Wednesday weekly options that SPY does. The cadence is slower, likely just one expiration per month, plus perhaps 1 to 2 leap years listed. This means if you want to do very short-term options trades, like 0 DTE or intra-week plays, SPY is the only choice. ChartExchange.com. Liquidity and open interest. SPY's options are extremely liquid. It's common to see tens of thousands of contracts of open interest at many strike prices and huge daily volume. For instance, a single weekly SPY expiration can have over 250,000 contracts open across calls and puts, and SPY's total options open interest across all expiries runs into the millions. Bid-ask spreads on SPY options are very tight, often just a few cents, even for at-the-money strikes. You can enter multi-leg spreads in size with minimal slippage. Market makers maintain a very active presence due to the ease of hedging. SPY options can be hedged via S&P futures or the ETF itself easily. OptionCharts.io. SPYM's options are much less liquid. Because the product, formerly SPLG, only recently garnered large AUM and the ticker change in late 2025 may have drawn more attention, its options chain is still developing. Open interest on SPYM options is relatively low, perhaps on the order of tens or hundreds of contracts at popular strikes. For example, open interest might be a few hundred on at-the-money SPYM calls or puts in the nearest month, and many strikes have zero OI. The chart exchange data above shows SPYM February 2026 calls had OI mostly under 600 contracts at each strike, and many FAR OTM strikes had no interest. Bid-ask spreads on SPYM options are wider, with some deep OTM strikes showing no quote, and ATM options likely having spreads of 5 cents or 10 cents or more, due to lower competition among market makers. Slippage can be more of a concern if trading SPYM options in size. ChartExchange.com, ChartExchange.com, ChartExchange.com. Implied volatility and pricing. Both SPY and SPYM options ultimately derive their pricing from the underlying S&P 500 volatility. In theory, arbitrage should keep SPYM's implied volatility in line with SPY's and SPX index options, since any large deviation would invite hedging opportunities, e.g., a trader could buy SPYM options and short SPY options or the index, etc. In practice, SPY's implied volatility surface is the market standard. Metrics like the VIX are based on S&P 500 index options, but SPY, being highly liquid, closely mirrors that. SPYM's implied vol should be very similar, but because of low trading, you might see occasionally stale quotes or slightly inconsistent curves until trading pressure corrects them. Generally, an investor shouldn't expect to consistently find cheap or rich volatility on SPYM versus SPY. Any difference is likely small and transient. Options strategy suitability. SPY is ideal for all option strategies, especially advanced ones. Its massive liquidity means even complex multi-leg strategies, iron condors, butterflies, credit spreads, etc., can be executed with tight pricing. Covered calls and cash-secured puts on SPY are very popular due to the tight spreads and Monday, Wednesday, Friday expirations. One can roll options frequently if desired. Day trading 0 DTE options, 0 day to expiry, is feasible with SPY because there's always an expiring contract on trading days. Protective puts or collars on large portfolios are efficient with SPY given the depth of the market. Simply put, SPY's options market is unparalleled. It's the go-to for traders needing high liquidity and specific contract dates. InvestLane.com. SPYM's options can be used for basic strategies, but with some caution. An investor holding SPYM could sell covered calls on it, for example, but only monthly expirations mean less flexibility in timing rolls or selecting optimal durations. The wider spreads suggest you might not get as favorable pricing. You may need to compromise on trade execution. For low-frequency options usage, like selling a monthly covered call or buying a put for annual portfolio protection, SPYM's options are serviceable, just use limit orders and be patient. However, for active trading or short-term strategies, SPYM's options are not as practical. If one strategy heavily involves options, like weekly income strategies, rapid delta hedging, etc., SPY is a far better choice to minimize trading friction. InvestLane.com, InvestLane.com. Open interest and strike availability. SPY, because of its long history, has strikes in fine increments, often $1 or even 50-cent steps for near-the-money strikes, across a huge price range. SPYM may have coarser strike increments or fewer strikes listed, which can limit precision for strategy setup. Moreover, SPY's enormous open interest, often concentrated at key strikes, can sometimes create more predictable price dynamics, max pain, pinning effects, near expiration, aspects that very active options traders monitor. SPYM's smaller open interest likely avoids any pinning phenomena simply due to lower participation. Summary of options perspective: if you value or plan to use the options market, SPY has a clear advantage. Its deep liquidity and 3 times weekly expirations make it one of the best vehicles for options trading in the world. SPYM, on the other hand, is geared toward buy-and-hold investors and thus its options are an afterthought, usable, but not nearly as flexible or liquid. An investor deciding between the two should ask, how important is options trading to my strategy? If it's important, SPY likely outweighs the cost savings of SPYM. If options are not a priority, or you only occasionally use them, SPYM's cost advantage may be more valuable. ETFsavant.com, InvestLane.com. Conclusion: which to choose? Both SPY and SPYM give you the same core S&P 500 exposure, same stocks, same diversification, and essentially the same performance except for tiny fee differences. SPY is the legacy behemoth with massive liquidity and an unparalleled options market, making it ideal for active traders, large institutions, or anyone who needs to trade in and out frequently or utilize complex option strategies. SPYM, with its rock-bottom 0.02% expense ratio, is a fantastic choice for long-term investors in cost-sensitive portfolios, where minimizing fees is paramount and trading/derivatives activity is minimal. Investlane.com. In summary, if you're buying and holding the S&P 500 for the long run, SPYM will deliver the same results with a slightly higher net return, thanks to lower fees. If you require maximum liquidity or plan to frequently trade or hedge with options, SPY's infrastructure is worth the marginally higher cost. Many investors even use a combination, e.g., hold SPYM in a retirement account, but use SPY for tactical moves or option strategies. Either way, both are excellent vehicles tracking the S&P 500, so the decision boils down to cost versus liquidity, SPYM for lowest cost, SPY for best liquidity, especially in the options arena. Investlane.com, ETFsavant.com, Investlane.com. Sources.